Okay, so the first one is quick study 5-4. Quick study in the back of your chapter 5-4. It says prepare journal entries to record each of the following purchases, transactions of a merchandising company. Show supporting calculations and assume a perpetual inventory system. And we said that perpetual inventory system means that they account for inventory how often? Perpetual. It means constantly, right? Because periodic would mean what? Like annual, right? So November 5th, it says purchase 600 units of product at a cost of $10 per unit. The terms of the sale are $210, net 60. The invoice is dated November 5th. So the terms 210, net 60 mean what?
210 is if they pay within 10 days, they'll get 2%. They can take 2% off.
2% discount. So this is what, 4, right? Okay, so for the first transaction, they purchased these units at what price? What price did they purchase the units for? $10. How many units did they purchase?
600.
600 units. So in order for us to find out that amount, we have to do what? Take 600 units, multiply that by $10, which gives us what? $6,000. That's how much they paid for the product, right? So what is the journal entry here? A debit to what and a credit to what? A debit to merchandise inventory and a credit to what?
Accounts payable.
Accounts payable for that $6,000. On November 7th, it said that they returned 25 defective units from the November 5th purchase and they received a full credit for them. So they returned 25 of those units, or you returned 25 of those units. And how much did they cost you? $10, right? So 25 units times the $10 means you returned how much product? $250 worth of product, which means that we debit what and credit what? Debit accounts payable, because that lowers our bill to be paid later, right? And credit what? Merchandise inventory for that $250. And then November 15th, it says that they paid the amount due from the November 5th purchase less the return on November 7th. So we can't say November 15th, is that within their discount period?
Yes.
It is? Okay, it's within the 10 days, right?
Yes.
So we started off with 6,000 units, right?
Yes.
We turned back in 250 units, which brings us down to what? 5,750. And then the discount would be on this amount. So we multiply that by, was it 2%? 2%, which gives us what? $115. So The journal entry should be what here?
Debit,
Accounts payable.
account payable.
Debit to accounts payable for the 5,750, which is this amount here, right? And then a credit to what?
Merchandise discount.
Merchandise inventory. And then also a credit to what else? Cash, right? Because that's what you pay. You're paying the bill off. So how much do we put to merchandise inventory? 115, which was basically the discount, right? And how much for cash? 5,635. Good. So something that, just in case somebody doesn't necessarily remember from last week, if we're talking about purchases, we put everything towards merchandise inventory. There's no, allowance account or discount account or something like that. There's none of that exists. All of it goes to merchandise inventory. Okay. But if we're talking about us selling our items, then we have accounts like sales returns and allowances. Okay. And that's where all of that would particularly go. And as we go on to the next one, then we'll see that. So the next one I told you to do was quick study 5-7, right?
We'll call that five.
Quick study?
Oh, okay, quick study, five.
Quick study was just 5-7, right?
Can I write this down?
Uh-huh.
I didn't get everything down.
Yeah, but right now we're doing the quick studies, right? So I said do quick study 5-7. So let me know once you have this. Okay, you ready? Okay, so quick study 5-7, it says prepare journal entries to record each of the following sales transactions of a merchandising company, show supporting calculations, and assume a perpetual inventory system. So first we start off with April 1st. Rhonda, can you read that for me?
So merchandise for 3,000, according to the customer terms of 2%. First 10 days in the month, invoice date August 1st, April 1st. Cost of merchandise.
Okay, so they sold merchandise for $3,000, right? And they're granting this customer a discount if they pay within 10 days. And it cost them $1,800 for the product. So in this case, the journal entry, we do 2 journal entries, right? Because every time you account for a sale, you also have to account for what else? The cost of the sale. So in this case, the first part of this transaction is the sale itself, and so we debit what? Accounts receivable, right? Because this is to be received later, and then credit what? Sales. What's the amount? 3,000. They gave it to you, so you didn't have to really calculate it. And then the next part of this, to account for the cost of that sale, which also happens on April 1st, we debit what? Cost of goods sold, right? And credit what? Merchandise inventory. And just to give you a, how much did it cost them? 1,800. Just to refresh you from last week. This is just saying we sold items, so we account for it in our revenue here with an increase. We put it on credit for the customer, so they owe us within 30 days or 10 days, however they choose to pay. And it cost us $1,800, so we're going to increase our cost account by $1,800, and we're also going to decrease our inventory because that went out to the customer. Everybody understands this, right? So we sold the items, so we account for our revenue, which is sales. It's all the same. We put it on account receivable because we expect to receive this money in 30 days or less. And then we account for what it cost us, and it cost us $1,800. So we increase our cost of goods sold account by $1,800, and we decrease our inventory by $1,800 because that was sold. Okay. April 4th, the customer in the previous sale, they returned merchandise to you, and you gave them a credit for $600. Okay. The merchandise that you received back cost you $360 for you to put back in your inventory. So what do we do first for April 4th? They returned merchandise back to us, which means we have to do what? Debit sales, returns, and allowances, because we gave them a credit, right?
Yeah.
And credit what? Accounts receivable, because we're decreasing their accounts receivable account because they returned back $600 worth of product to us. And then we have to put it back in our inventory with a different journal entry by debiting what? Merchandise inventory, because it was returned to us, and crediting what? Cost of goods sold. You're just doing everything in reverse from up here. And how much did it cost us? $360.
Okay, so the 1,800 is the cost of goods, right?
Correct.
So when we get down to on the 4th,
Mm-hmm. They returned $600 worth of product.
oh, okay. So
It only cost us $360 though.
for the $600.
It cost them $600. They returned it to us. We gave them a $600 credit. It only cost us actually $360 for those units that they returned.
Right, that's what I'm saying. Based on what they returned, not on what they purchased, because they only returned. They didn't return.
The way it works is that when you give them an allowance or a credit, it's based off of what they actually paid for the items.
Okay.
And when we put it back in our inventory, we base it off of what we actually paid for it. They didn't break it down by units this time. They just gave you the numbers instead of, because normally they would tell you you paid $10 for it and you sold it for $14. They didn't do it that way. They just gave you a blank amount to put up there. And then lastly, April 11th, it says receive the payment of the amount due from April 1st sale less the return on April 4th. Now my question is, are they in the discount period on April 11th?
Yes.
They're in the discount period. So if they're in the discount period, we not only have to do the discount on the amount less their credit, right? Their return. So originally their amount was $3,000, right? And then they returned $600, so we subtract that, which gives us $2,400. And they're paying within the discount period, so that $2,400 times 2% discount gives us what? How much? $48. So the journal entry needs to be a debit to what? Think about what's happening. Now the customer is paying you for what happened here. What did you receive?
Cash.
You received cash, right? And then we're gonna debit what else? What did you give them?
A discount.
A discount. So sales discount which we know was $48, right? And then you've been saying accounts receivable, so we're gonna credit that for how much? Your 2,400, right? Because that was what it was before the discount, which means you actually received cash of how much? 2,000 what? 352.
One second, I'm spelling.
No, that's fine. I'm not gonna move it.
Debit sign should be the cash sign.
Well, yeah, the debit side, as long as cash received plus whatever the discount was. Now, if they didn't get a discount, let's just say they didn't get a discount, like, and they didn't pay within the period, right? This would obviously not be here, right? And that cash would be the full 2,400 that they owe after the return that they made. That's if they didn't get the discount. But because they paid within the discount period, discount is debited and the amount of cash.
Okay, so if it was the 12th, it was on the 12th.
Mm-hmm.
This would have been the 24th.
It just would have been 2,400 that they owe back. That was it for the quick studies, right? Okay, next is exercise 5-5. Exercise 5-5 says Allied Parts was organized on May 1st and they made their first purchase of merchandise on May 3rd. The purchase was for 2,000 units at a price of $10 per unit. And on May 5th, Allied Parts sold 1,500 of the units for $14 per unit to Baker Company. Terms of the sale were 210 net 60. Prepare entries for Allied Parts to record the May 5th sale in each of the following separate transactions, A through C, using the perpetual inventory system. Okay, so first we need to record the actual sale, right? The initial sale that happened on May 5th. So on May 5th, they sold these items. And if we account for sales, we also have to account for what? When you account for sales, you also have to account for the cost of the sale or cost of the goods. And so when they sold it, what journal entry do we, well, first let's calculate it. How many units did they sell?
2,000.
How many did they sell?
1,500.
1,500 units. At what price? $14. They sold it. We're on exercise 5-5. They sold 1,500 units at $14, which means they made how much? 21,000. Now it cost them how much per unit? $10. So 1,500 units times that $10 equals what? That's simple math, 15,000, right? So to record the sale itself, we debit what? What's the account? Accounts receivable, right? Because you're selling an item on credit. And credit what? Sales. What amount? 21,000. We have it up here. Now to record the cost of this sale on that same day, we debit what? Cost of goods sold and credit merchandise inventory, because your inventory is decreasing. And what amount? 15,000. Now they want us to record these other things. May 7th, Baker returns 200 units because they did not fit the customer's needs. Allied Parts restores those units to its inventory. So basically the customer is returning back how many units? 200 units. And how much did they pay for them? $14. And how much did we pay for them? 10. So 200 units times $14 equals what? And then 200 units times $10 equals what? 2,800 here, 2,000 here. So to restore it back, to account for the credit that we extended to the customer on May 7th, we debit what? Sales, returns, and allowances. And credit what? Accounts receivable for that 2,800, right? And then on that same day, we put it back in our inventory. So we debit what? Merchandise inventory. Credit cost of goods sold for the 2,000. On May 8th, the customer discovers that 300 of the units are damaged but are still of some use, and therefore they keep those units. Now, us as the company, we give them a credit for $600 to account for the damaged goods that they have. So basically, we didn't get the items back, so it's no need for us to put them in our inventory. The customer is going to keep them, but we're going to extend to them a credit for $600 for just keeping the inventory. So what do we debit and what do we credit? Remember, we're not putting it back in inventory. We're just giving them a credit.
So the credit is just to say, hey, to make everything even, you just keep it in.
Correct.
We're gonna take a hit.
Correct.
Okay.
So sales, returns, and allowances is what we debit. And what do we credit? Accounts receivable, right? Lastly, on May 15th, they discover that 100 units are the wrong color. So the company is going to keep 60 of them, but they're also going to extend a $120 credit to the customer to compensate. And then, yes, a lot going on. And then 40 are returned back to our inventory. So this is how it went. There were 100 units. They were all the wrong color, right? The company was able to keep 60 of them. And then we also extended a credit for $120. And they gave us back 40 of them to put back in our inventory. So, yeah. It's still two different journal entries. But all we need to do is the calculations. We gave them back how much? Well, Well, we gave them a credit of 120, right? And then they returned how many items?
60.
40. They returned 40 items at what price?
14.
$14, which means how much ultimately do they get?
560. Well,
120
plus 120.
680, right? This is their allowance ultimately. So on May 15th, we debit what and credit what? Sales returns and allowances, right? It's still the same process.
So how is their allowance greater than 600?
Greater than what, 600?
Um,
Return to 40.
you get a credit? Oh,
We did. But we also gave them a credit memo. You can't leave that out. All in one. Yeah. So far, ultimately, what we're doing in this transaction has nothing to do with the 8th. The 8th is its own. Let it go. We're over it, right? We reported it. But going down to the 15th, they returned 40 more units. They kept 60, so we gave them a credit for keeping those 60 because they were the wrong color. So we take the 120 that we gave them as a credit, we add it to the fact that they returned 40 of those units to us to give them a total credit of 680. We accounted for that, but we also have to account for what? Because we got inventory back this time. The cost of that inventory we got back. And we know that they came back with 40 items and it cost us what, $10? Which means we got back $400 worth of product, which means that we debit what? You're getting it back. So merchandise inventory and credit what? For 400. Got it? I'm gonna let you write that down before. And we're not gonna do exercise 5-6 because essentially it's the same thing. And for the sake of time and having to go over what is required for your project, you can bypass that altogether. Ready? Exercise 5-11, which will be our last one. The following list includes selected permanent accounts and all of the temporary accounts from the December 31st, 2015 unadjusted trial balance of Nico Company, a business owned by Kuni Nico. Use these account balances along with the additional information to journalize adjusting entries and closing entries, and they use a perpetual inventory system. So the first thing for us to do are to do the closing entries, and they have some additional information. The information says accrued sales salaries in the amount of $1,700, prepaid selling expenses of $3,000 have expired, and a physical count of year-end merchandise inventory shows 28,450 of goods still available. So the three adjusting entries, the first adjusting entry we have to do is for what account? You have sales salaries, right? No?
Salary,
Sales salary. What did they say? They said
cruise sales salary,
they accrued sales salaries, which means if you're doing an adjusting entry, you're gonna debit what? They accrue sales salary. You are doing an adjusting entry.
sales salary expense,
Sales salaries expense and credit what?
Sales salary,
Sales salaries what? Salaries what?
pay,
Payable.
pay,
For how much?
for 3,000,
What did it tell you there?
17.
1,700. The next adjusting entry, they had some selling expenses that expired as well, right? So what do we debit? What do we credit?
the prepaid selling expenses, so it's
Prepaid is not prepaid if it expired, right? So selling expenses. And then credit what? Prepaid. We're taking it out of prepaid, putting it into putting into the actual expense account. And then lastly is the inventory. We had how much inventory to start? 30,000. They said the count on at the end of the year was how much? 28,450, which means that we have to adjust for how much? $1,550. So we debit what and we credit what? Debit what? Credit what?
Okay.
Adjusting for inventory. What do we debit?
Merchandise,
You don't debit that
You,
because it's decreasing. They're saying what they have on hand is not what they started with, which means that it has decreased by 1,550, which means yes, you debit cost of goods sold and credit merchandise inventory for that 1,550. Now, what we need to do now is look at what some of these accounts, their new balances. Sales salaries expense. Did it have a balance before? At the beginning? How much? 48,000. Is that what you said? So 48,000, and we need to add what? 1,700, which means our new balance equals what? 49,700. Salaries payable. Did it have a balance before? No. Do you see salaries payable on there?
No.
So it didn't have a previous balance. What about selling expenses?
Yep.
Yeah, 36.
Selling expenses started off with what now?
36,000.
36,000, and then we added what? 3,000, which means
39.
it's now 39,000 is the new balance. Prepaid selling expenses. What was the balance it started off with?
5,600.
5,600, and we decreased it by what? 3,000. So now the new balance is
2,600.
cost of goods sold. Did you have something? Did it start off with the balance?
Yes.
Yes.
What was the balance?
212,000.
212,000, and we increased it by 1,550, which means our new balance is what? 213,550. And then merchandise inventory, we know that balance is 28,450, because that's what they said the end of year balance was. So now we have to do closing entries, right?
Yeah.
And I know this chapter was not the best for many of you. But step one, we close what to what? Revenues to income summary, right? So we're gonna debit what?
We're gonna debit.
To close it, you have to do the opposite of what its normal side is. So in this case, we debit what?
Salary expense.
We're closing revenue to income summary. What is considered your revenue on that list?
Cost of
Revenue, meaning money you got, money you received for products sold.
Expenses on it.
Sales. I have told you over and over again, sales are the same as revenue. It's the same thing. It's just a different name because we are talking about merchandising business. Right?
So I have a question. All of what we have up there is, I mean, we've got expenses up there, right? So the selling expense is not what you're talking about. You're talking about the actual sales.
What are we doing in the closing process right now? Closing revenue to income summary, right? What's the only thing revenue that you have on that list? Sales. That's what we're dealing with right now currently until we move on to the next step. Don't jump ahead. You still got to go through the same process. Close revenue to income summary, then close expenses to income summary, then close income summary to capital, then close withdrawals to capital. So it's just a closing process all over again. You just have a few added accounts such as discounts and sales returns and allowances and so forth. So step one with closing revenue to income summary. Yes, ma'am.
Okay. If you could just read that up one more. Okay, I'm just gonna.
I'm not going to erase any of it. I'm just trying to finish the problem.
Okay.
So we debit sales for how much? How much? 529,000, and we credit what?
income summary.
Income summary.
Same amount.
Same amount.
I'm lost, to be honest.
No, you're not. No, you're not. I don't want anybody to use those words because you are not lost. You are overthinking. We just did this in chapter 4.
Okay, so where do we get the?
That little grid at the bottom, you see where it says sales, 529,000? That's what we just put up here to record revenue being close to income summary.
Okay.
What's the next step in the closing process?
Close expenses to increase.
Close expenses to income summary. And you have several expenses there, right?
And
Identify them before I just write them on the board.
prepaid,
Prepaid stuff.
No, that's not an expense.
Oh, the sales salary expense.
Sales salaries expense, utilities expense, selling expense, administrative expense. What else?
Prepaid salary.
That's an asset. Anything prepaid is an asset. Cost of goods sold, sales discounts, and sales returns and allowances. Those are your expenses. So we know that we debit income summary, right?
Okay, so the allowances that's an expense because.
It's
Of
just
the
an
credit?
expense. It's just an expense. Sales discounts, sales returns and allowances, cost of goods sold are all expenses. They do not occur until what happens? Until you do what? You gotta sell something, right? It doesn't exist before then. It has no reason to exist before then. So it's an expense, because that's how expenses happen, right? You don't know you have a utilities expense until what happens? You get the bill. Same thing goes with these things. Cost of goods sold does not occur. Sales discounts does not occur. Allowances and returns do not occur until what happens?
Sales.
Until you sell some products or they return some products or something like that, right? So this is why they're listed under expenses. So we know we debit income summary here, right? And we credit all the expenses. What were the ones you called out? Sales salaries expense, selling expense, cost of goods sold, utilities, administrative, discounts. Are there any others? Sales returns and allowances. Are there any others? That's it? I got administrative, sales salaries, selling. Okay, I have all of those. Okay, so sales salary expense, what's the amount? The new amount. After the adjustments, what's the new amount now? 49,700. Selling expense, what's the new amount now? 39,000. Cost of goods sold, what's the new amount? 213,550. Utilities, what's the amount? 15,000. Administrative expense, how much? 105,000. Discounts, 5,000. Sales returns and allowances, 17,500, which means income summary is what? Gotta add all these up. 49,700 plus 39,000 plus 213,550 plus 15,000 plus 105,000 plus 5,000 plus 17,500. Say it again. 444,750 Now, before we go on to step 3, which we know is to close income summary to capital, you gotta find out what income summary is, right?
Yeah.
And you do that by doing what?
Subtract the
Take
revenue.
sales of 529,000,
Subtract the revenue.
subtract expenses of 444,750, which equals what? 84,250, which is ultimately our net income, right? And also income summary. That's what income summary is. So now step 3 is to close income summary to capital, which means we debit what?
You debit and
Okay.
Debit income summary
credit.
for what amount? 84,250. Was there confusion? I heard a okay. So confusion.
It's just moving like really too fast and coming right now.
Tell us. We got time. What part? Where you stuck?
Still at the numbers, like,
What numbers? What numbers?
when we started subtracting, 529 minus the 444.
What is 529,000 signify?
So that's,
And what is 444,750?
expenses.
Right.
And the minus-
And when we subtract expenses from revenue, that gives us what? Because that's what's on the income statement, right?
Yeah.
Revenues and expenses. What else so far?
Okay, I'm getting that.
Okay. So this net income amount is what's in the income summary account.
So revenue and income is same.
No,
You said not income, but revenue is still.
no.
Revenue is money you made, expenses
Yeah.
is what you paid to make that money.
Right. So she was asking, where did we get this number from? The 84,250. And that is our net income amount, which came from us deducting what from what? Say it. What from what?
Expenses from the expenses.
Subtracting expenses from revenue. What else so far?
Yeah.
You sure? I don't want to move forward if you're not.
No, I'm getting back. It's just, as soon as I write one thing down, y'all want something else, so it's like,
So that's why we want to stop right now. I want to know if
Okay.
you're with us.
I'm getting back right now. It comes something we need for.
Let me know when you're ready before I go to this last step. And that's with any of you. You know that you're not where we are, then maybe you need to say, okay, I don't understand. Can we go back? There's nothing wrong with doing that at all.
Okay.
Okay, a question, on the income summary up there, is that, it looks like 494, is that 494 or 444?
444,
Okay,
444, 750.
at the top up there?
Uh-huh.
Oh, okay.
444,750. Can you see that now? Does it look right? You with us so far? Okay, so what's step 4 in the closing process?
We close
Close withdrawals to capital. So if we have to do the opposite.
You said close withdrawals.
To capital. So we debit what?
You debit withdrawal. No. You debit capital.
Are you decreasing capital? You're not decreasing capital. What are you doing?
Debit withdrawal.
Well, you are decreasing capital. I'm sorry.
You debit cash flow and you credit withdrawals.
Right, cause the normal side of withdrawals is what?
Debit,
What was the amount?
30,
What was it, I'm sorry? 84,000.
250.
250.
You with us on that one? Please. Okay.
Yeah.
You don't track, if they have withdrawals, you don't track the withdrawals.
That's what we did.
How do
What
we
about
draw
they
it
have
from the
withdrawals of 33,000?
I could find y'all now. What would you give me 84,000?
Oh, we
I thought you were talking
paid
about
for
capital.
capital.
No, you are closing withdrawals to capital. I asked you what was the amount of the withdrawals. Why would you give me 84,000?
Yes, 61,000.
So. How much is withdrawals?
33,000.
33,000?
Yes.
Even?
Yes,
Yes.
But you put that up there with capital.
cause you closing.
You are closing
withdrawals.
withdrawals to capital.
So, alright,
I think where y'all are going wrong, you completely forgotten chapter 4. I think that's part of the
It's
problem.
not that we completely forgot it, it's just, it's very confusing.
I don't know how, it's 4 steps.
it's like when it says, capital to withdraw, in my mind, I'm thinking you need to subtract 33,000 from the 84
Right?
in order to get whatever that,
That's where y'all confusing yourself. Don't worry about what you're getting. You are taking withdrawals and taking it from capital. That's it.
okay, cause that's the only way it can be closed, is with that
Correct.
capital, okay.
Because withdrawals is a what type of
It's-
account?
it's from-
debit.
Yeah, I got you, it's an asset.
Temporary.
Okay,
Permanent accounts are not closed.
alright.
Temporary accounts are. What are our temporary accounts? Revenues, expenses, and withdrawals. I think y'all be trying to get to the, whatever's the end. I don't know. Go towards the light. That's what you're trying to find. So we get discombobulated. I don't know, but the 4 steps again of the closing process are what? Step 1 is what?
You going to close revenue to income
Close
summary.
revenue to
Income
income
summary.
summary.
Then you
Step 2,
close income summary to expenses.
close expenses to income summary. Step 3, Step 4.
Cash flow for withdrawals.
Yeah, but you was so, what that expense?
That's it. No, that's it. But I know that
It
it's.
sounds easier than it is. Because when you go, okay, like, I had an issue with the very first one, when you say do the opposite
Uh-huh.
of close
To close
revenue.
it.